good morning, Trinidad and Tobago, and welcome to the Bourse Report. Merry Christmas and all the best for the season to everyone. And today we're taking a look at the financial report, or the results rather, of one Canadian-owned bank and one formerly Canadian-owned bank, or soon to be formerly owned Canadian bank, FirstCaribbean International, for their financial year end of October 2020. Now, both banking groups would have reported lower earnings and as well as some lower dividends overall. Let's take a look at the performance. So let's turn firstly to Scotia, and for that financial year ended 2020, October 2020, the group reported an earnings per share figure of $2.95, which was a 22% decline from the $3.79 reported in the prior comparable period. On the bright side, revenues weren't down as sharply. Net interest income was down just around 1%, from 1.32 to 1.31 billion. Overall, total revenues were down just around 4.4%, from 1.86 to 1.78 odd billion dollars. Non-interest expenses actually were a little bit lower as well, from 767 to 757 million. However, the big change was net impairment loss on financial assets, which increased 59.3% from 144 million to just around 230 odd million. Income after tax, as a result, was down that 22.1% from 668 to 521 odd million dollars. Now, when we take a look at the revenue composition and growth trend for Scotiabank, we can see that over the past few fiscal periods, there has been a trend of slowing revenue growth. In 2017, revenue growth was around 7%, slowing to around 2% in fiscal 2019. And in fiscal 2020, as mentioned, there was a decline overall of around 4% on average. Now we can see again, net interest income has held its own, relatively stable, declining at just 1% in fiscal 2020. Other income, however, would have declined around 13% odd, from 535 million to 465 million. So the question really is, can Scotia turn this around in the upcoming fiscal year? Well, much of that will be dependent on the overall economy and economic conditions, and whether or not the arrival of a vaccine sometime in 2021 to our shores will turn around economic fortunes, as well as what would be impacting Trinidad and Tobago's economy in the main, which is the energy sector. Will that turn around as well? So when we take a look at total loans versus impairment losses, as mentioned, revenues weren't that bad. However, credit loss or expected credit losses or impairment losses on financial assets would have increased quite significantly relative to the total loan book. And we can see that for the past few years, fiscal 2017 to 2019, it has been around the 0.7 to 0.9% level, and that would have spiked fairly dramatically to around 1.4% or 1.3% for fiscal 2020, suggesting some deterioration in loan quality. However, in the wider context of things, 1.3% in terms of expected impairment losses on a $16.7 billion total loan book isn't that significant. So it suggests that still, despite some deterioration, the bank is maintaining pretty good credit quality overall in its financial assets. So at a price of $55.33, Scotia is trading at a price-earnings ratio of 18.8 times. And despite having cut its dividends by about 25% for the fiscal year, is still offering investors a dividend yield of 4.1%. Despite that, the stock would have fallen about 9% for the year, but on the basis of fair valuations, and with some light at the end of the tunnel for COVID and its impact on economic conditions, but still with lingering uncertainty, Bourse maintains its neutral rating on Scotia. Turning quickly to FirstCaribbean International, and for its fiscal year, the group would have recorded a loss per share of 68 cents compared to the 70 cents recorded in the prior comparable period. So a very significant $1.38 change in fortunes. Total revenues were down much more pronounced for FirstCaribbean, 7.2%. From 4.1 billion to 3.8 billion US TT dollar equivalent. Operating expenses were also down moderately from 2.68 to 2.65 billion. However, the two big items for FirstCaribbean in the fiscal year ended were the credit losses on expenses on financial assets, increasing from 24.4 million to just around $1 billion, as well as the impairment of intangible assets, particularly goodwill, to 1.169 billion, which was not there before. When we take a look at total revenue and expenses trends for FirstCaribbean International over the past few years, we can see that total revenues have been somewhat stable. Again, there was a fairly significant decline this year by about 7% from that 4.128 billion to 3.8 billion. Operating expenses have been fairly contained as well. However, the two big influencers, as mentioned, were the credit loss expenses. And we can see that it has fluctuated over the past 3 years, but moving from 24 million TT equivalent to just around 1.1 billion TT equivalent is quite a significant jump, as well as that one-off impairment expense, hopefully of the goodwill, which would have been a 1.17 billion non-cash hit to the earnings of FirstCaribbean. So again, fairly significant moves which would have impacted the earnings of FirstCaribbean. However, with some normalization or gradual economic normalization across its major operating jurisdictions, Bahamas and Barbados comes to mind, we would hope that there would be some improvement in earnings, especially as one-off items such as that goodwill write-off and a normalization of credit loss expenses, or perhaps even a write-back as loan quality improves, would help the earnings of FirstCaribbean in the future. So at a price of $7.05, well, there's no PE ratio because of a loss recorded in the fiscal year. However, FirstCaribbean trades at a market book of 1.7 times, which is slightly below the sector average of around 2 times, and offers investors a dividend yield of 3.5% on normal dividends, including its special dividends. It's a whopping 6.5%, and those dividends are paid in US dollars. So on that basis, again, with the outlook for gradual economic normalization and having, again, overlying that context of lingering uncertainty, especially for the Caribbean jurisdiction and the recovery of tourism and how long that is going to take, Bourse is going to maintain its neutral rating on FirstCaribbean. Well, that's it for this week's edition. For more information, give us a call at 2BORSE or 226-8773. Email us at invest@boursefinancial.com. And of course, you can check out our website at bourseinvestment.com, where all of our research is absolutely free. And of course, you can catch us today in the business section of the Bigger, Better Trinidad Guardian. Have yourselves a wonderful investing week. This has been the Bourse Report.